Hi, I'm Steve Walters with Straight Talk Commercial Real Estate Academy, and this is Steve Harper. And in today's After Hours, we're going to be discussing real live deals that are going on right now in our brokerage business. So, Steve, welcome. How's it going?
Very, very good. How are you?
Doing great, thanks. All right, so the whole purpose of this segment, Steve, is to demonstrate real life commercial real estate deals for agents who are thinking about getting into the business. Maybe they've already got 1 foot in, kind of figuring out where they fit in the business, seeing if it's right for them, or maybe even just at the contemplation stage of, should I get into commercial real estate? What's it like? So let's talk a little bit about what it's like to be a commercial real estate agent. How's that sound?
Sounds good to me.
Perfect. So let's, I guess, start off by talking about some deals you're working on right now.
Well, I mean, it's probably important. We can certainly get into my deals, but it's probably important to note that with the brokerage, we have a brokerage outside of the schools, and with the brokerage, our focus is pretty laser sharp. Our brokerage really focuses primarily, and you'll find 90, 95, probably more % of our business is either multifamily or retail. And not even retail. When I say retail, I mean more laser focused than that.
A specific niche within
we
retail,
really
correct?
Tend to focus right now on single tenant triple net lease deals or multi-tenant triple net lease deals, long-term leases or properties that are positioned for that. So we're in a subcategory under the retail side.
So Steve, let me just ask you kind of a clarifying question for folks who may not know what a single tenant net lease property is. In layman's terms, what is that?
To make it super easy, it's usually a freestanding building that's entirely leased by one tenant. And that tenant might be like a McDonald's, a Burger King, a Jiffy Lube.
Maybe Starbucks?
Starbucks is one. Urgent care centers are another. Medical. You can go the gamut as far as industry. You could have an industrial single tenant retail deal. FedEx has a hub somewhere, I guarantee you, and that hub is net. It's a triple net lease, and it's a single tenant deal.
And it could even be office as well.
Absolutely.
It could be something small, right? Like a small restaurant, or it could be something big like a Wells Fargo corporate location, office building.
Yeah, since we actually took our brokerage to a laser focus at our property type, our business has tripled.
So you're saying that specializing in 1 or 2 particular areas is better than trying to...
Well, I was raised in Arkansas, so I've always heard there's a lot of ways to skin a cat, and there is a lot of ways to get there. But yes, I think that a very big key to my success, and most people that I meet, I find when I run across someone in this business that's very successful, I find they're focused. They tend to not be generalists. They will all occasionally take a different property type here and there, and I do. But as a general rule, I stay very true to my multifamily and my retail properties. I refer everything else out. I know people that are industrial focused, and I'll send my industrial referrals on over and collect my nice little referral fee that when you start figuring time value of $1, I'm probably making more per hour on my referrals than I make on my business.
So do you prefer to work with small investors, corporate investors,
in our brokerage? And again, we have identified that clearly. We're small to mid-size investors. In the multifamily side, we're really focused. I've taken bigger listings. I closed a $14 million deal last month, so they happen. But as a general rule, you will see that we live in about a $2 to $5 million. That is our sweet spot. That's the small to mid-size investors. We like to help them preserve the wealth that they have, plan and structure for the future, and then help them through it as we go. That's really our focus and our niche.
So how would you say that is different than working with residential investors from an agent perspective, right? Because we've got folks who, they purchase houses, right? They maybe they've got 1, 2, 5, 10 different rental homes, and they have them, and they've got some renters here and there, and their end goal is to create some level of cash flow until a certain amount of time in which they sell. How is that different from the investors that you work with these property types that you were just talking about?
Most of the time they're the same investor. The only difference is the investors I work with are the ones that have either been educated to or educated themselves to the commercial world. A lot of times I will go after those single-family homeowners that own 2, 3, 5, 10 single-family homes. I will actually target them. I still utilize the MLS, and I don't really want to list and sell residential property, but I do target them as a client because they are wonderful clients for me to educate right into single-tenant, triple-net lease. Most of those investors I found in my life all have the idea when they began this 20 years ago, 30 years ago, or 40 years ago that eventually they were just going to cash out. They were just going to cash out, bite the bullet, pay the taxes, and buy that Winnebago.
That
and
seems pretty
hit the
common.
road.
That is a very common thing that I saw when I was a residential agent.
And that is all well and good, and people always remember that long-term capital gain, but I never have found anybody that remembers the depreciation recapture. And when they start realizing how long they've owned some of these homes and how much that tax bill is really going to be, when you start thinking 30, 40, 50% of your equity, it starts to look daunting to actually ever be able to do that. So obviously we educate and we'll go in and we'll teach about 1031 exchange. These people, though, all they know is single-family homes, or even they might know apartments and say, yeah, but I want to get out of that. I don't want the day-to-day work. I have to manage the manager. They know that. Or they're managing it themselves. So we educate them into the single-tenant, triple-net lease that has literally very little to no landlord responsibilities. The property taxes are paid by the tenant. The insurance is paid by the tenant. The maintenance on the property. My goodness, if you had a Burger King with a corporate lease on it and a car drove through the side of the building because it was 2 in the morning and it was a 24-hour store and they were drunk, that tenant is who has to pay the deductible to the insurance company, not the landlord.
Right.
And the tenant is required to maintain business interruption insurance in case that car ever does drive through the side of the building. So what? The landlord always gets his check when? On the 1st of every month. So it's an education piece for us.
Okay.
Mm-hmm.
So what would you say is the percentage of investors that maybe migrate towards commercial? Do you think it's maybe 1% of residential investors move to commercial, 5%, 10%? What do
you ever played
think
Monopoly?
It is? I love Monopoly. That's my favorite game.
Okay.
I usually win too. Just FYI, in case you ever want to play.
We'll invite him over for Monopoly and I'll get him set. I'm talking to the camera person because I want to make sure that we take care of this. It's like Monopoly, Steve. It's the same thing. I don't know what the percentage is. I have no idea. And if I even venture to guess, it would be low. It would be on the low side. It might be 20% or less, probably, that I would actually say that are aware of commercial. Because commercial has this stigma. People assume, well, it's far too complicated for me. I'm just a small residential investor.
Or too much money, perhaps.
Yeah, I've had guys that own 15 single-family homes. Most of them they own outright. And I've initiated a conversation about commercial, and I've had them look at me and say, Steve, I'm just a small investor. I can't afford that. I need, $10 million to be able to start investing in commercial real estate. And that's just not true. There are some parts of this country where your single-family homes are going to cost you more than your commercial property.
Very
and that's
true.
just a reality.
Well, let me ask you this. I mean, we all grew up playing Monopoly.
Well, isn't there a time when we need to cash those 4 houses in for a hotel?
So why don't people do it? Why don't investors realize that maybe they can do it? Or why do you think it doesn't happen?
Because there's not enough residential realtors that have stepped outside the box and gone ahead and taken the jump to add commercial to their book of business. Statistically speaking, I've said this before in our training programs or when we speak live, and I'll say it again. Statistically speaking, if you look at just NAR statistics, not Steve's statistics, because we all know that we can flip those any way we want, right?
Sure.
Looking at NAR statistics, they ran something, I believe in 2015, the average realtor made somewhere that did no commercial made somewhere around $45,000 a year. I don't remember the exact number.
45,800.
And okay, 45,800, and the average commercial that did one or more commercial deal a year, in addition to their residential business, did an average of like 125, 126,000.
Agree. Yep.
So it was
Exactly.
something like that.
Yep.
That's a huge differential. And the other part is you've got 1 million realtors out there that are competing with all of you for single-family homes. You've only got about less than 40,000 commercial practitioners nationwide competing for like $500 million worth of business. Well, when you split that up equally, everybody should be selling 10 million or more. I mean, just on an average.
On the average. Absolutely.
Everybody should. And we all know that that's not how it works. It's an 80-20 rule. 20% of the people that are watching this video will actually take some of it to heart.
And then there's the
something with
80-20 of the 20%.
That's right.
And so you really got 5% of the people doing 95% of the business.
Yes.
It really is that way.
It really is that way.
So
yes.
would you say that education, as far as from a realtor perspective from a realtor to an investor, there is an education gap between what is actually available to these investors versus what they actually know.
They don't know. But imagine the niche. If you are a residential investor or you're a residential broker and you work with investors, and there's residential brokers and agents out there, and that's what they're doing all the time, right?
That's
and
right.
they've got all these investors, these guys and gals that have amassed all of these single-family homes. Now, if just one or two of those brokers was educated enough to teach their client base what's available out there.
Not even that you have to do it, but
no,
here's what is available. By the way, did you know about this?
Did you know that you can invest into a bond-like real estate investment that really is just mailbox money every month and no management? No, I did not. Tell me a little bit more about that. If we did that alone is not only going to increase the realtor's business, but isn't it also going to be a huge benefit to the client and the end user and ultimately the consumer who we're all trying to protect as we go along this world and make a buck?
I believe so. It's just a shame because when I was selling houses and investment properties, I had a lot of investors, with duplexes and fourplexes and condos and small properties to create that cash flow. But there was never no one ever asked me what else was out there for investment purposes. And
if we don't know,
since I was in the world of residential, I didn't understand that there was more out there until I actually started getting into commercial and doing some deals and figuring out what it was. And now I'm kind of see these two perspectives and a whole another plate of options, so to speak. You got your residential plate with your hors d'oeuvres, and then on this plate that you haven't even seen before, it comes out of the kitchen, and you've got all these fancy hors d'oeuvres from all over the world. It's something like that. It really is like a metaphor.
And ultimately, Steve, commercial's not harder or easier than residential. It's just different. It's a different set of rules. It's a different set of circumstance. It's a different set of tools. But other than that, it's the same.
And once someone really understands the basics, they'll see that light bulb switch, and they'll be able to take action.
Certainly.
Have you seen the movie The Big Short?
Yes.
So I just watched that last night on Netflix.
Is that the first time you've seen it?
That was the first time I've seen it. I didn't really understand the title until I watched it. But
watch it a second time.
That scene where the guy says, what do you smell? What do you see? And the guy said opportunity, and he was like, no, money. That's what I
smell fear on you.
I smell money. And it was very interesting because it was like something that wasn't known, and then once it was brought to light, it turned into this whole big thing of selling these short options or whatever they were. but it's very similar in the fact that we don't know what we don't know until someone actually shows us.
That's right.
So there's a lot of opportunities, and some of the opportunities you were talking about. Now you said you are into retail, so you've got a couple of these retail single tenant, triple net deals going on.
I have, let's see, we have a DaVita Dialysis Center in Houston, Texas, under LOI right now. It's getting ready to go to contract. I have 2 Burger Kings, one on the East Coast, one in the Midwest. We've got a 24-hour fitness in Henderson, Nevada that we're flirting with a little bit at the moment. I've recently sold multiple Denny's. I'm getting ready to go to a franchise meeting and meet all of the franchisees in October in Orlando. So I'm looking forward to that. That's going to be a very fun trip.
So sounds like you're doing deals all over the country.
I do deals all over the country, yes.
Now before we don't want to probably go into how that's
giving
possible
legal
on this
advice.
particular
No, we're not
video.
going to do that.
Maybe we should
there's
do
ways if you want to.
video.
Yeah, someone wants to shoot us an email. Make sure we'll make
maybe
sure
our next interview
we'll be out of state deals.
We'll talk about some out of state
let's
deals.
talk about how we do it. Sure.
But for the purpose of here, what is maybe pick one of those deals that you're working on. Maybe it's the DaVita, and what's it like working that particular deal? Just kind of give an overview of how this deal maybe came to be, and then how you're progressing through it.
We found the deal on LoopNet. We contacted the broker. It's about 78% DaVita, and then about the remaining, and it's about ballpark. So we'll roughly say 75% DaVita and 25% a neuropathy clinic, which is a pain management that kind of goes hand in hand with DaVita.
Okay.
Interestingly enough, the neuropathy group actually is the owner of the building. So they're doing a sale leaseback. The lease is already in place for DaVita. So I will tell you some things about that deal. Number one,
Please do.
That deal has CPI increases annually in it with a 2% cap for DaVita.
Hold on, CPI?
It's a consumer price index. It's just keeping up with inflation.
Perfect.
So you'll follow a market, and up to a cap of 2, it can adjust upwards to 2% a year. The property was offered to us with that lease in place, and then a flat sale leaseback with the neuropathy group doing a 10-year sale leaseback with 1 5-year option. DaVita has 12 years left on their lease, and they've got 2 5-year options. And they offered this to us, and we kind of went in and looked at it. We looked at the price that they offered it at. We looked at the terms. We actually walked in and we took them a full price offer.
A full price, you didn't negotiate on the price?
Not on the price. I negotiated on the terms. We discussed it with the client, and we decided that the price that they offered it at was close enough to market that even if we got a little bit of play in the price, it was not going to be significant play. That there was a better play to go in. Again, they were offering a flat lease to go along with this one that adjusts every year. Neuropathy group is not near as good as a corporately guaranteed DaVita. So what we did is we asked for a CPI increase, very similar to the one that DaVita has, which they were not offering. We said, we'll give you your price, but you have to give us our terms. And our terms are, we want CPI every year, we want a 1% floor and a 2% ceiling. So we matched the 2% ceiling and we added a 1% floor. And then we went in and said, okay, we also want every time that an option is exercised. So if they exercise the 5-year option at some point in time, that's a full CPI adjustment with no cap, no lid on that. We also said that instead of a 10-year lease, which is what they offered, we told them we wanted a 15-year lease out the gate. We'll give you your price, but you've got to give us our terms. So again, we know DaVita is going to be there for 12. Now the neuropathy group, we're saying, is going to have to stay there for 15. We have a default in the event that that group does not that they counter us. We have a default position to go to. I'm really not at liberty to discuss that part on this film, as that negotiation could still have to take place in the future, and I really don't want to get into what our backup is. But what we basically did is we looked at them and said, all things being equal, we'll give you what you want price-wise, but you need to make the terms a little bit better, which is much better for my client.
Well, that's very out of the box.
Yeah.
I mean, that's not as simple as just writing up an offer, a contract, and throwing it out. I mean, that seems a little bit more in depth.
That's why the ramp up to get into commercial real estate. I mean, even for a seasoned residential person, I would say 6 to 12 months to ramp up, because there's a lot of little education that comes.
So with this particular deal, first of all, are you in contract?
We're under LOI.
Okay.
So we're under letter of intent. We're working through a contract.
And so, how long have you been working through this initial offer, letter of intent?
Letter of intent last week, contract this week.
Okay, so you've been negotiating for about a week or so.
Yeah.
Okay.
We found the property the week before.
Okay. And when do you think it'll be in contract this week? It's Memorial Day weekend right now, but
yeah, no one's really going to work today. Today's Memorial Day. Happy Memorial Day to you.
You as well.
Mm-hmm. But yeah, we should be able to wrap the contract up this week or early next week. It depends on how many attorneys get involved.
So can I ask you some of the non-confidential details about this transaction?
Ask away.
Okay. So is this a cash purchase? Is this a finance purchase?
This particular one is going to have to be financing. It's going to be about $2.5 million cash in and about $1.5 million worth of financing, ballpark.
That's about 40% down. That's about 60%,
yeah.
40%.
It's a 1031 exchange requirement. They have to replace the debt. They had about $1.5 million down on what they sold, so they're going to need to replace that debt or bring in new cash, and they've opted to in this market, this interest rate market that we're in right now. It's a silly time not to take debt. And on a property like this, I can actually get non-recourse insurance company money for my client.
So you have a lender kind of lined up already?
Yeah.
Excellent.
They'll do a 25-year fully AM deal. Right now, 4.5%-ish on a 25-year deal.
So what are the timelines as far as this deal is concerned? Inspections, financing contingency, close.
We did not do a financing contingency. We disclosed in the letter of intent that we're getting the loan, but we waived the financing contingency in the offer.
Okay.
We don't need the contingency on it.
So you're confident that you can get the financing on it?
We've got about 5 days to get into contract, and then 35 days of due diligence. In that 35 days, we can get the financing put to bed.
Okay, perfect.
In this particular
so
deal.
you're satisfying it within the
yeah.
normal contingencies.
Right. But we made it clear that there is no that it's waived. We accentuate the positive when you're doing an offer. So I
absolutely
made it very clear that we were waiving the contingency.
And then how long is it going to take you to close this sucker?
45 days.
45 days from the start, or 45 days from when
60
you remove
60 from when we started dancing with them. Yeah.
Okay. Mm-hmm. So that's not too terribly long.
No.
Okay.
And I've closed triple net deals in 10 or 12 days when they're cash.
Right.
Mm-hmm.
That's a very interesting deal. So as far as, let's compare it to a residential investment.
Okay.
What is the biggest difference between buying, other than the price being a little bit more than a house? So what are the main differences between an investor buying this particular property versus a house, or maybe even a couple of houses? What are the most striking differences just right off the bat?
There's nothing to manage with the DaVita. There's just nothing to manage.
What do you mean by there's nothing to manage?
You really don't even need a property manager to take care of the property. I mean,
so paying taxes, who pays the taxes?
The tenant.
Insurance?
Tenant.
Maintenance?
Tenant.
I kind of already knew that, but I wanted to help demonstrate that for the folks.
Tenant's paying everything.
So the tenants pay everything, the landlord doesn't pay anything, maybe just verify that their taxes are being paid.
You have to stay awake at the wheel. You still have to watch, make sure things are being done. I mean, it'll say that, when tax bills come out, they have, within 30 days, they have to get that paid and then show you proof that it's done. So you have to watch the mail and make sure that that's happening, or the email, however you're set up to do that. But it's very, very, very low management, which is the biggest striking difference between a single-family home and that kind of investment.
So is the tenant usually required to tell the landlord that, hey, the taxes have been paid,
Yes.
everything has been paid,
Yes.
So it's an active responsibility
Yes.
of the
It
tenant?
depends on what it says in the lease. This is why you
Okay.
have to do your due diligence in your lease on these types of properties. Because the law in commercial is what it says on the four corners of the paper that everyone's agreed to. That's the law. It's not like you've got a consumer protection thing out there, which we have in residential real estate. So you have to pay attention, and buyer truly has to beware. And so does the seller. Everyone's got the assumption in commercial is that everyone knows what they're doing. So if you don't, make sure that you do.
Sounds kind of dangerous, doesn't it? We
If you
assume
don't know
everyone
what,
is
if
knowing
you
what we're
don't know
doing.
what you're doing, it can be very dangerous, yes.
Okay, so we've got this big difference between a house when you have to have a management company, you've got day-to-day management and operations, and versus this thing where you really don't have any management. So we've got this mailbox money. What are some of the what are some of the other differences between these two?
Residential and commercial. The leases that are they're pure triple net leases on the commercial side. On the residential side, if you're dealing with houses or apartments, you've got a lot of landlord responsibilities within those leases. You've got to maintain the property. You've got to keep it in working order. If something breaks, you've got to go in and fix it. Management is huge, and not wrong. Again, I've known a lot of people that have made a lot of wealth in residential real estate. I've known people that have made a lot of wealth in commercial. I known people that have played in both arenas. Otherwise, it really truly is two pieces of real property. When you break it down, it's still a foundation and sticks and a roof, and that's really what it comes. That's really what it comes down to.
So, as a residential investor, they're looking for essentially cash flow and resale value, right? They're trying to ride the market. They're trying to buy low at the market, and then sell high, obviously. Mm-hmm. So with this DaVita dialysis building, if you're holding on for 12, 15 years, obviously you're looking at cash flow, right? Mm-hmm. But from an appreciation, market timing perspective, is it the same as residential, or do you just
that works differently? And
how does that work?
We could probably devote an entire after hours segment to that.
Let me write that down so I don't forget.
We ought to do it, but basically, it's. I don't know where to go with that. I don't know where to go with that, Steve. That's a huge question.
That is.
So yeah, I don't even know where to summarize on that one. I can't really summarize on that. There is an answer to that, but that's a big answer. That's a huge answer.
That's a big answer.
Yeah. It needs a lot of background and quantifying. Yeah.
Okay. So that sounds like a very interesting deal, Steve. Give me one deal right now that's maybe a little bit out of the ordinary for you. Maybe something that happened recently, or just something that you're working on right now.
I sold a vineyard. I closed a vineyard last month in July, or I guess a couple months ago now. We're in September now. But yeah, we closed a 103-acre vineyard in the Napa Valley. We set a record-breaking price point for this sub-market within Napa, and I actually paid out the largest referral fee I've ever paid in my entire life on that particular deal, which was awesome.
So let me ask you, what was the maybe one or two key takeaways that you learned on that deal, or new sort of revelations or something like that, where you came out of the deal with a new perspective? Give me your thoughts on something that you learned about this deal.
First of all, I was hired for that deal because I didn't know what I was doing.
You what?
I was hired because I didn't know what I was doing.
Please expand on that.
When I interviewed, I was asked how many wineries or vineyards have I sold? And I've sold a few, but they've been hobby vineyards over the years. I've never ever sold a truly working vineyard. It was, what I've sold has been, 5 acres with a beautiful home and a presentation, or 12 acres with a beautiful home and a little tasting room that makes everyone feel good. This was a 103 acre ranch. And I frankly said, no, I've never sold anything like that. Well, that got me one check box. I'm watching and listening, and we're talking some more. And he said, well, how much do you run with these Napa brokers that are selling this stuff? I said, well, I don't. I'm an investment specialist. I generally am single tenant, triple net lease, and I am generally multifamily property. And he said, that's great. You're hired.
Huh?
What?
Wow.
What this client wanted was someone who didn't. He called them napkins. He didn't want me to be a napkin.
A napkin.
Which is a Napa. I don't know, something he says about Napa
Oh, that's
brokers.
funny.
But he didn't want me to have preconceived ideas about the vines in this particular market, about this area called Woodin Valley in Napa. And I didn't have any preconceived ideas. I didn't have any ideas. I didn't know anything, really, about growing grapes. From the time I took the listing until the time we closed it, it was about 1.5 years.
I imagine you learned a lot through this process.
Yeah, the listing took a great deal of shape. And to take a listing like that, there's a lot of expense for a broker. It's a commitment to take a big listing. As you can't just take it and hope something happens. You have to make something happen. It's an active responsibility. So we learned quite a bit about vines. We learned about quality and assessments. And by the way, the buyer we ended up getting for that deal had his own broker, but was one of the biggest vineyard owners in North America. It was a company called St. Michel that came in and purchased these vines in this 103 acres. Mm-hmm. And we set a new price point by over 20% per acre on what was planted because of the quality of the vines. The fact is, I was hired because I was dumb and didn't have preconceived ideas. Because I didn't have preconceived ideas, I saw no reason why not to list it at what the seller's argument for the quality of the vines was enough for me to list it 20% higher than I could find any comps for. But there was really no comps to speak of. They were all very, very old and dated. There was just nothing that had sold in this marketplace.
You really had to set a new
I had no
price.
reservation about doing it, and when it came time to discuss this with possible suitors and buyers and brokers and agents, I had no qualms about talking the quality what I knew it to be. Because I read the reviews of the wine that was coming out of there. I knew who was buying this wine, slapping their label on it, and winning gold and silver awards all over the world. I knew this was happening. So I had no preconceived ideas, and I acted exactly that way. And my dumbness was able to make me pay a $140,000 commission to the gentleman that referred to these folks to me, these sellers. I was able to set a new price point by like 27% in the submarket area. It was exciting doing that deal. By the way, the client sold that and exchanged a substantial portion of that investment into a single tenant triple net lease drugstore.
What a great thing to transfer into.
Yeah, it was wonderful.
So it met their needs, and they were. And I know a little bit about this transaction. So they were retiring, correct?
Yes. Semi-retired. They still have a little bit of work. Yeah.
Are you ever really truly retired?
I don't know if these people ever will be.
Yeah. Well, that's very interesting because most people and most agents, brokers, think that in order to get a specialty deal or something like this, you would have to have, gobs of experience. You'd have to have some huge resume. You'd have to be somebody in a crowd, right, to even be considered for something like this, let alone an out of area or an out of area broker, really.
I disagree. I think all you ever really need is an audience. If you can get the audience, then the conversation can get you the deal, and it can get you the business. The confidence that the client sees in you on the other side of the table. And I think the ability to look a client in the face and say the words, I don't know. I'm not sure. No, I haven't done that. As opposed to embellishing and pretending that you've done something you haven't, I think is refreshing to a lot of people that are interviewing people just like you and I.
Well, it's honest.
Every day. Mm-hmm. Bottom line is, if you can get the audience, you can get the deal. That's what I think.
That's a great lesson. That's
Yeah.
a fantastic lesson right there.
Mm-hmm. Yeah.
Excellent. Well, I think we're running short on time, Steve. So why don't we just go ahead and wrap this up? But I think we got a couple ideas for our next after hours. So we'll continue this conversation on those out-of-state deals, and
Can't wait to talk more about it.
and the equity versus the cash flow conversation, because we've done a video and we presented this to investors at one point in time.
Sure.
This cash flow versus wealth building perspective, and maybe where does an investor sit on this range, right, from wealth building to cash flow, which is stable to a little bit more risky. So that'll be an interesting conversation that we can have, and
Perfect.
it should provide some new ideas to agents and brokers out there who are dealing with investors.
Yep.
Simple as that. All right. Well, thanks, Steve, for joining us,
Thanks for having me.
and thank you for joining us. And we'll see you on the next episode of After Hours. Take care.